our viewers on the various social media platforms and televisions. I'd like to take this opportunity to welcome you to the reading of the Monetary Policy Statement for October 2023. On our agenda, we are going to have two items. One, reading of the statement by the Deputy Governor, and two, a Q&A session where we'll take questions from journalists in the room and other questions coming in through the online platforms. Before we start, I'd like to take this opportunity to invite the members of BOU management team that are before you. I'll start with the Deputy Governor, Mr. Michael Atingi-Ego. On his left is Dr. Twine, who is the Executive Director of Supervision. And on his right is Dr. Adam Mukume, who is the Executive Director of Research. Without further ado, I'd like to invite Deputy Governor, Mr. Michael Atingi-Ego, to go ahead and read the Monetary Policy Statement for October 2023.
Thank you very much, Director of Communication, and a very good afternoon to our listeners and viewers. Welcome to the reading of the Monetary Policy Statement for the month of October 2023. On 5th of October, the Monetary Policy Committee, MPC, maintained the central bank rate, CBR, at 9.5%. Despite the recent increase in the fuel pump prices, annual inflation has continued to moderate, reflecting the implementation of appropriate monetary and fiscal policies, the fading impact of the drought on food prices, and the easing of the global cost pressures. Annual headline and core inflation dropped to 2.7 and 2.4% in September 3, from 4.9% and 4.8% in August 2023, respectively. The inflation outlook has changed from the August 2023 forecast round. Now we have the downward trend in inflation is predicted to continue in the coming month due to lower imported inflation, further easing of food crop prices, and subdued aggregate demand, but will return to target in the medium term. Inflation is forecast to be in the range of 3% to 4% in the fourth quarter of 2024, and back within the 4% to 5% range in 2025. These projections are, however, subject to risks. On the downward side, global inflation could fall at a faster pace, potentially affecting domestic inflation. In addition, we could get a bumper crop harvest, which would push down food prices further, leading to lower inflation. On the upside, foreign exchange depreciation due to volatility in international financial markets and escalation of the ongoing geopolitical conflicts could lead to further energy supply cuts and higher domestic fuel prices. Moreover, prolonged higher inflation in advanced economies could lead to higher interest rates, triggering further capital outflows and spilling into further exchange rate depreciation. The MPC assesses the risk to be balanced in the short term, but tilted upwards in the medium term. Since the last MPC meeting, near-term prospects for the economy are broadly unchanged. The recent quarterly GDP estimates by the Uganda Bureau of Statistics, UBOS, indicate that quarter-on-quarter real GDP growth for the second quarter of 2023 stood at 5.2%, a much faster growth compared to 0.4% in quarter one. The faster growth was due to strong recovery in the services and the industry sectors. The high-frequency indicators of economic activity also point to continued growth in the 3 months to August 2023. Economic growth is projected to remain strong in the coming months due to continued recovery in services and industry sectors. Economic activity will be boosted by investments in the extractive industries financed by foreign direct investment and higher export earnings. Economic growth is therefore projected to be around 6% in financial year 2023/24 and in the range of 6% to 7% in the medium term. However, the outlook is subject to a range of uncertainties, including 1, slower global growth, posing a risk to domestic growth. 2, a resurgence of supply chain distortions due to geopolitical factors. 3, tighter fiscal policy in part due to unfavorable global financial markets that could restrict government development expenditure. And 4, stronger moderation of household expenditure, in part due to tight monetary policy conditions globally and a reduction in agricultural output due to bad weather. Based on this assessment, the MPC considers that the current monetary policy stance will continue or will contribute to keeping inflation around its medium-term target, supporting economic stability to encourage saving, investment, economic growth, competitiveness, and socio-economic transformation. Therefore, the MPC decided to maintain the CBR at 9.5%. The bands on the CBR have been maintained at plus/minus 2 percentage points, and the margins on the CBR for the rediscount and the bank rates at 3 and 4 percentage points respectively. As a result, the rediscount rate and the bank rate will remain at 12.5% and 13.5% respectively. The Bank of Uganda will take the necessary policy actions to ensure that inflation stabilizes around its medium-term target of 5%. That marks the end of the reading of our monetary policy statement for the month of October 2023. Thank you for your very kind action.
Thank you very much, Deputy Governor, Mr. Michael Atingi-Ego, for the monetary policy statement. We will now go into the questions and answer session. Please introduce yourself and the media house you represent, and then go straight to the question. If the statement was very clear, please let us know so that we move on. I don't see any hand in the room. Okay, we will check online whether there are any questions through the online channels. Mwanga Oscar online, can you go ahead and present your question? We are going to ask you to repeat the question. Volume is very low. Could you raise the question again? Okay, Mr. Samuel Setumba, please go ahead and raise your question.
The real estate sector, which could be one of the areas of recovery in terms of economic growth. The second question, I missed the first part of the governance question, but I'm not repeating myself. The question of fuel prices. How much is it? Fuel prices, especially from the global market.
The first question is on why commercial banks have lowered their lending to the real sector and what that means for recovery. And the second question is on what we expect on developments for the fuel prices and how this will feed into inflation going forward.
Okay, thank you. Is that someone? Yeah, thank you, Samuel. Yes, you're right that private sector credit growth from particularly the banking sector has reduced. I think the latest numbers are 6.7% year on year for the quarter. Yeah, about 6.7. There are a number of factors that are explaining that, but let me just highlight two factors. You recall the fact that we have been tightening monetary policy right from the month of June 2022. We raised the policy rates by 350 basis points over a period of 4 months, and then also we raised the cash reserve requirements by 200 basis points, which tightened liquidity in the banking system. Now, to the extent that the transmission mechanism of monetary policy takes anywhere about 12 to 18 months, we are seeing that the impact of those actions are now contributing to reduced aggregate demand, and therefore that is partly reflecting why the demand for credit from the banking sector also has come down. But then the other aspect is that the quality of the assets in the banking sector has been partly affected by the lingering effects of the COVID-19. You remember, following the onset of the COVID-19, the Bank of Uganda put in place credit relief measures, which expired just about a year or so ago. And as a result, some of those loans have actually proved to be non-performing now. The loans that were benefiting from this credit relief have, some of them have tended now really not to perform at all. So as a result, most commercial banks have how to write off those or have how to provide for those loans in their books. Now, the commercial banks have become very, very risk averse in lending. And so they are still dealing with the impact of ensuring that the quality of the assets that they are creating through loan creation is actually is good. So with that at the back of their minds, it has impacted the extent to which they are extending their credit and just giving only to customers that they are sure are going to repay. So that history of the non-performing loans that is coming from the COVID-19 impact, it has somewhat affected the quality of the assets and hence the reaction by the commercial banks. I don't know whether EDR has something to add or EDS has something to add to that.
No, what I can slightly add on is what someone said. He was referring specifically to construction or the real estate. And out of the 22 trillion shillings in loans 22% of that is basically real sector as of August. So the argument, therefore, that real sector is being crowded out of this of the credit market, I don't think is right. However, it is true that all sectors, apart from personal loans, have faced decline in credit extension, as DG has mentioned. But so happened that real sector still is actually the biggest share consumer of credit at 22%, followed by personal loans. So overall, the decline is across the sectors, not necessarily real sector. That's what probably I could add. Thank you.
And then there was a question on the pass-through of oil prices to inflation and how this is likely to play out in the coming period.
Yes, again, thank you for that question. Maybe let's begin from the very basics. The Ugandan pricing system is very liberal. It reflects the costs, and also it reflects what is happening on the international price. So once the oil prices go up, and it's likely to be reflected in our pump prices as well. And also it is compounded by the fact that depending on the direction of the exchange rate, it could also have a multiple effect, a double effect. So if let's say your international oil prices are increasing and your exchange rate is depreciating, that is certainly going to have a double impact on the pump prices, because that is reflecting the fact that there has been a change in the pricing as a result of those two factors. So that pass-through, there's a full pass-through that we are observing. Remember that we don't offer any subsidies to fuel products. So there is a full pass-through that we're seeing. Now, in regards to the actual percentage of the pass-through to from the increase in the pump prices, a 1% increase in the pump prices to the domestic prices, I don't have a number for that. Maybe Director Research, EDR has got the pass-through from increase in fuel to CPI.
Not that I have a clear pass-through, but again, fuel takes about 6.5% of the CPI basket. So basically, what we're talking about, even if the international prices have risen, but again, given that the percentage of the CPI basket in the percentage in the CPI basket is very small at 6.5%, then the pass-through is quite small. However, we also need to take note that at this time last year, fuel prices actually were much higher than where they were in terms of international prices. So basically, that's why even now, although we are seeing an increase, again, compare this with the last year, you find that actually it is almost at the same level. So, and as DG says, so if this increase in the oil prices persists going forward, because now some of the effects of 2022 will be washed out, then that's when we start seeing bit of increase. Mainly so, if the increase in pump prices feeds through the transportation cost, transporting, say, matoke from villages to the town, etc., I think that's really where we see a manifest effect, because now it will start affecting the service sector and also the food component. Overall, I think it is quite difficult to estimate the transmission mechanism, given that the whole it becomes a web. It spreads from one side to the other, but still, in the shelves of CPI basket, fuel is a small component.
We have 2 more questions from Mwanga. The first one is Uganda's inflation is within target and is expected to remain anchored. What would trigger easing of policy, and how much do external interest rates influence BOU decision? The second question from Mwanga is, Please share your thoughts on exchange rate controls we are seeing in the region and the possibility of contagion to Uganda.
If I got you correct, you're saying the first question has got to do with inflation being within target and what will trigger what? Easing. That's a very good question. You know, when we decide on how we are going to change the central bank rate CBR, we take a forward-looking approach. We forecast a number of factors where they're going to be going forward, but most importantly, what is the inflation? What is the inflation outlook? Now, based on that, we then decide how to change monetary policy, either to tighten it or to keep it stable or to reduce it. So we're guided by the forward-looking aspects of inflation. But also there are a number of risks that we take into account, because you might have a forecast of inflation either remaining stable or coming down. But if you look at the risks, they are the upside risks that I mentioned earlier on, and then there are the downside risks. So depending on where these risks are tilted, if they are tilted on the upside, notwithstanding the fact that your projections are indicating inflation will be coming down, in such situations where you have risk tilted on the upside and the uncertainties, then you are likely not to ease. You are likely either to keep your CBR the same, constant, or even consider maybe revising it slightly upwards. So it is a combination of the outlook in inflation going forward and where the risks are tilted. So that is what decides whether we are going to ease or not. And then, to what extent do foreign interest rates affect our decisions domestically? Again, Uganda has an open capital account, and that open capital account allows the free flow of capital into Uganda. So we have a number of non-residents who are investing in our financial assets and other areas of the economy. Now, if the foreign interest rates are increased, like in the recent past, as most of the central banks in the advanced economies are putting in measures to contain the rising inflation, if the interest rates in advanced countries are increased, then the investors in our financial assets will have to recalibrate that. Do they remain in Uganda, or they move back their capital to what they call the safer havens, or where the interest rates have now increased, given some of the risks that are associated with emerging and frontier economies. So a rise in the interest rates in the foreign foreign countries will result into a reconsideration by investors in our assets. Should these investors decide to pull out their investments, it's going to have an impact on the exchange rate, because they're investing in Uganda shilling assets. They brought their dollars in here, they converted into shillings to buy the Ugandan shilling-denominated financial assets. Now, if they are going back, they will have to liquidate the shilling financial assets, buy the dollars, and then go back. Now, that action of buying back the dollars is what causes a depreciation in the foreign currency, particularly if a number of them are pulling out at the same time. That will exert depreciation pressures on our currency. Now, if we are looking at where is inflation going to be in the coming month, and the currency has depreciated, certainly there will be a pass-through into our domestic price level. And that domestic price level will then be a part of the component in forecasting where the inflation is going to be. So if that results into our inflation going above our medium-term target, then it triggers an action by the central bank, by Bank of Uganda, to adjust its policy rate. So I don't know whether that link is now clear. Okay. And then the other one has got to deal with exchange controls. I'm not sure whether there are any countries in the region that have exchange controls. It's not to the best of my knowledge. But of course, there is sometimes availability of Forex in the market. That's a different matter. But I'm not aware of any country with exchange controls. Maybe EDR, you're aware of it.
No, I think probably what he was referring to was administrative sort of management, like where a central bank says if you have to request particular amount of dollars from, say, the central bank, from a commercial bank, not forex bureaus. Those are some of the administrative arrangements that some countries have implemented. But that's not necessarily exchange rate control. It is part of the management toolkit to say that, okay, if you are demanding a particular amount, say beyond a particular, say $10 million, instead of from the Forex, you go to a commercial bank, because the commercial bank has clear modalities of, giving the dollars. So that's really not necessarily changing of policy in terms of whether the currency is floating or not in some of those countries that you have mentioned. Overall, under East African Community, we have agreed that currencies must be floating, no fixing.
We have Fred, whose question is, what is the likelihood that the lowest inflation since January 2021, registered in September 2023, is linked to low demand in the economy? I'll go ahead and read a second one from Katongole. World Bank finance suspension. Has the central bank gotten more clarity or an update to share in this space on the impact it will have on the growth outlook?
Okay, the first question was that we have the lowest inflation since 2021, and
what's the link between this inflation and
aggregate demand?
Yes.
There's certainly some link between that low inflation and the low aggregate demand. Like I mentioned earlier on, since June 2022, we have been tightening monetary policy. And the reason for tightening monetary policy is to check the growth in aggregate demand, particularly at a time when the supply side is being affected by a number of conditions. Take, for example, we had the disruptions in the supply chains last year, which affected, the efficient delivery of a number of intermediate goods and what have you. So in that case, demand was partly, supply was partly disrupted. So what you need to do in that kind of situation is to, in the interim, you need to see how you can equilibrate demand to the available supply. So we tighten monetary policy to lower aggregate demand. And like I said, the full pass-through of monetary policy into the real economy, including inflation and growth, is about 12 to 18 months. So yes, aggregate demand has slowed down, and it has partly resulted into the low inflation that we are now having. But now that we are bringing inflation to to control, and the supply side is now responding properly, or has begun to respond. That's why in the last monetary policy committee meeting, we lowered the MPC rate, the CBR rate by 0.5 percentage points, and also lowered the CRR by another 0.5 percentage points, because we now wanted to see how that could translate into an increased aggregate demand, because we think that we are now firmly containing inflation, and therefore now there was need to re-trigger the growth in aggregate demand while supporting the supply side. On the World Bank, I think we have been in touch with the Minister of Finance. And as you recall, the amount of the World Bank financing that's affected is mainly the loans that have not yet been approved by the World Bank board. Now, the loans that have been approved by the World Bank board will continue disbursing, of course, under a number of conditions, making sure that there is no discrimination in the beneficiaries of these loans, but those loans will continue disbursing. It's only the new loans that are yet to be approved by the World Bank board that have been affected by that World Bank statement. Nonetheless, if you look at how much is affected for financial year 23-24, we have been advised by the Minister of Finance that it's under $40 million, at least for this financial year. Now, the bulk of it could have come in the medium term for financial year 24, 25, 26, but we don't yet have those budgets. Now, what's happening is, of course, government is talking with the World Bank to see how best they can come to a common position on this so that they can resume disbursing those loans once the World Bank board has approved. But even if the approval is not yet given by the World Bank board, I think government is working out options on what to do with the $36 million that would have come this financial year, either to look for alternative sources at similar terms, or to do anything that does not jeopardize macroeconomic stability. Now, its impact on growth, of course, is that if the bulk of these loans were coming to support the productive sector of the economy and they're not forthcoming, then it would affect growth going forward. But I won't believe that that's not the objective of the government, to have growth being affected. I think government will look for alternative financing at similar terms from the various creditors. Thank you.
Yes, please go ahead.
Well, good afternoon. Talking oil, you recently had a visit to the Albertine Graben. Just want to know your thoughts around the progress on that particular project and what the future holds, especially with the fact that Uganda, we all expect to have its first drop by 2025. Leon Sanyangis, CGTN.
Leon. Okay, thank you, Leon. Yes, it's true. I visited the Albertine region over the weekend, and I must say it is an impressive development. It's one of its kind that we've had in this country. So, looking, of course, at what's going on in the various oil fields. Take, for example, the Tilenga and the Kingfisher. A lot of activities taking place in there. And this follows the conclusion of the final investment decision. We now have begun seeing activity come into play. A number of the production wells have been drilled, and I think the first commercial oil, I think they're on track to get it. And certainly the central processing facilities and all the other supporting infrastructure is actually being undertaken. So there's every reason to believe that the first oil production will be in 2025, 2026. So in terms of what that means, of course, is we are going to have our exports of crude oil around that time, and that will enhance our capacity to earn foreign currency. But most importantly, once the refinery is up and running, the plan to have the petrochemical industries I think is going to be a game changer as well, because we will be reducing on the amount of forex we're spending on importing refined fuel products, while at the same time earning more through crude oil exports. So the impact of that on the FX market is going to be huge, because I think we're spending close to $1 billion importing. What's our import bill? About $1 billion. So just look at a percentage of that remaining. Even if it's just 60% of $1 billion, that is $600 million. Add that to your crude exports. Okay? So the impact is going to be quite significant on the economy, besides creating other value chain industries and supporting the linkages that are to be found in the oil sector. So the multiplier impact is certainly going to be strong. That's why we're projecting a 6 to 7% growth in the medium term, driven partly by that investment and the coming on board of the oil production. So I think that's in summary what I can say. But importantly, it is having an impact on the industries, on the activities that are going to support the oil production. And that should contribute to higher GDP growth, besides contributing to socioeconomic transformation.
We will take one more question and then close the session. There is a question online, and the question is, please comment on the comments that the shilling is overvalued. And the other one is, what is the outlook for the exchange rate, and what are the risks, the upside and downside risks?
Okay, I will attempt to answer the one on the overvaluation, but I will ask EDR, since that is his cup of tea. You see, overvaluation is determined by a number of factors. You assume that there are factors which drive the level of the exchange rate, and this is what we call the fundamentals. So if you were to use those fundamentals for determining where the currency is going to be at a particular point in time, and if the currency is not at that level, let's say it's above or below, then the currency is said to be misaligned. So depending on where it is, it could be above, then it's undervalued. It could be below, then it is undervalued. Now, depending on the model that you've used for arriving at that equilibrium exchange rate, the one that's determined by the fundamentals. So there are various approaches, to doing that. Now, depending on the approach that you use, one approach can give you it's overvalued, one it is undervalued, and also the extent of the overvaluation can vary depending on the approach. But also the overvaluation is affected by a number of what we call temporary factors that might cause the currency to move out of its equilibrium. So take, for example, if right now we received $800 million in terms of the portfolio flows, and that is not part of your fundamentals, it will cause the currency to appreciate and shift it out of its equilibrium rate. Now, that one will cause overvaluation of the currency based on the fundamentals. So overvaluation is really a technical thing which is affected by the way you are projecting your equilibrium exchange rate and what is affecting your current level of the exchange rate. So depending at what point in time you are talking about the overvaluation. So that's how I would answer that one there. The exchange outlook is, again, the exchange rate is in Uganda is determined by the market forces, supply and demand. So I cannot tell you where the exchange rate is going to be in December. It will be dependent on the supply conditions, on the demand conditions. But of course, as a central bank, we have to have some working numbers. We have our own projections, internal working projections. And sometimes those projections could deviate a bit because, again, there are a number of factors that affect the exchange rate. But I cannot tell you what is the outlook. The outlook, of course, is that we will try to do everything possible to maintain stability in the currency. And stability in currency does not mean that it is fixed. No. We will tolerate reasonable movements of the exchange rate using our policy instruments. And that's how we look at stability. But to tell you that the exchange rate is going to be this in December, I cannot tell you. But all that we can tell you is that we will try to ensure that it's stable.
Thank you very much, everybody, for tuning in. And with that, we've come to the end of the reading of the Monetary Policy Statement for October 2023 and the Q&A session. Have a great day and God bless you all.